Right, guys. Hello. Zaheer Anwari here on behalf of the Dynamic Trader. Can I get a quick hello that you can see me and you can hear my you can hear me as well, hear my voice, hear me as well. Okay. Yesterday I was having some issues. Thank you, administrator. Yesterday I was having issues with my charting. So I'm just going to bring up my charts. Can you let me know that you can see my charts, please? So I'm showing my charts right here at the moment. Are you able to see my charts? Still chat. Okay, so we're having the same issue as yesterday. Okay, I'm just going to close down my charting package. And I'm just going to restart it. So I'm restarting my software. My software is eSignal. Okay, and it's restarted now. Okay, so is my charting visible now, please? No. Okay, how about now? Okay, so you still got the Hangout, still no charting coming through. This is frustrating. Okay, can you see my eSignal now? Yes, okay. And is it still showing, or is it the chat that is showing now? Okay, fantastic. Okay, right. Let's just stick to the charting for now, because I don't want to lose it. So, yeah. Thank you, administrator. Thank you for resolving that. Apologies for that. I had the same issue yesterday, but we managed to resolve it. So let's stick to the software. So the whole topic of today, really, which is a bonus webinar that FX Street organized, is they kindly asked me to talk about my projections for 2017. It's an interesting topic because whenever people ask me about projections, what do I see happening in the future? My answer is generally, I don't know, and I let price dictate that. So I'm not an expert. I'm not one of these gurus that you find on television that will confidently tell you the euro dollar is going to be here. The Japanese yen is going to be here. Gold is going to do this because of this bit of news that's coming out. Oil is going to do this, that, the other. There's always these experts who are paid a lot of money in the limelight to sound like they know what they're talking about. And generally, those predictions don't always come correct. Let's take the Dow, for instance. I know this is an FX Street webinar, so it's predominantly currencies. But just to highlight my point, I want to talk about the Dow. And if I bring up the monthly chart, you can see that the Dow has been creating new highs since 2009. So since 2009, excuse me, the Dow has been in this bull run. 2009 all the way through to 2015. After every bull run, the market has to consolidate. This is a natural feature of any market, regardless of what you're looking at. Gold, the euro dollar, a stock, it doesn't matter. First of all, doesn't move in a straight line. So you'll notice, even though we're in a bull run, there's these periods where it goes up, comes down, goes up, comes down, up, down. And you see that all the way through for 6 years. So that's the first feature to price that you must embrace. The second feature to price is that after every move, the market consolidates. And that's exactly what happened. And this consolidation was for over a year, a long period of consolidation. And then there's a breakout. Now, the breakout is more likely to happen in the direction of the trend prior to the area of consolidation. And we're going to look at some currencies that are displaying these same characteristics. Breakout just here. So we're now in the month of December. So in the last month or two, there's been a real there's been a real breakout to the upside. There was a bit of a breakout going back a few months prior. So December, November, October, September. So around July, around that period, July, August, we had a breakout to the upside. It was short-lived. We had a reversal back in to retest the 18,000 level, and then we've had the bounce up in November and December. Now, as these highs are being created, you will often hear in the news that these highs cannot be sustained and there is going to be a reversal at some point. You had tried and predicted a reversal from 2009 to 2015. That's a 6-year period that you would have been wrong. Yeah, there was a little bit of a period here where it reversed, but this is more of a correction. And that's simply because price broke through the major support level of 10,000. So it came back to retest it and then went on the next leg. So my point is, you really want to ignore a lot of predictions and you want to allow price to dictate what it intends to do for the coming days. And there's a very simple way of looking at this. And the answer is round numbers. If price breaks one round number, then it's very likely going to move to the next round number. Think about if you're jogging. If you break 13 kilometers, you want to get to 14, then 15, then 16, then 17, and you want to try and make it to 20 kilometers. If you get past 20 kilometers, you'll think you'll start again, 21, 22, but you're not going to stop at 22.4 kilometers unless you get injured. Psychologically, you're going to try and get to the round numbers. So 21, 22, 23, you may not make it to 25, which may be your ultimate goal, but you'll make it to 23 kilometers, and that's where your stamina takes you to. Price in the same way. Look at where price is heading towards now. Major resistance in the form of 20,000. If it clears this level, then 21, 22, 23, so on and so forth. And this is the way you want to allow price to dictate to you projections that are going to come in the coming months. We've got the same logic happening on the Nasdaq. So we can see that the Nasdaq has broken through. And when I say broken through, it's broken through these pink lines. And what do these pink lines represent? The pink lines represent the high, the low, and the close of the previous calendar year. So that's the high of 2015, the low of 2015, and the closing price of 2015. So these annual levels, if price is trading within these annual levels, I consider it a consolidation. What I want is price to be trading outside of these levels, either to the upside, where price has a bullish bias and I look for long opportunities, or to the downside, where price has a bearish bias and I'm looking for shorting opportunities. Just to note, I don't trade the indices. I use them as a guideline. But I'm just saying this to highlight the point. Now, you can see that it's trading to the upside. If it clears 5,000 of resistance, then we're going to see price move towards 6, 7, 8, 9. Those are the levels. Okay, so let's go back to currencies. And we're going to start with, and I'm going to be focusing predominantly on the dollar pairs. And that is because those are the currencies that are looking the most interesting. I'm not looking at them because they're the majors. I'm not looking at them because they are paired to the US dollar. No, I'm looking at them because those are the currencies, those are the group that are displaying signs of potential trends. And I am a long-term trend trader. And now to the market in a few days or a few minutes or a few hours. I'm looking to hold positions for as long as possible. Foreign exchange, I've held positions for 8, 9, 10 months. Stocks, I've held positions for over a year. So when these trends are in play, they're in play for very long periods of time, and the growth that can be achieved is significant. Very large percentage growth on a single trend. And that is because when I hold and the trend develops, I compound, I scale in, I add. The logic behind that is really do less for more money, for more profit. Day trading, scalping, first of all, it's inconsistent, it's stressful, but it's very, very unnecessary. Get away from that idea that thinking that day trading is the way forward. It isn't. Okay, so if we look at the euro dollar, the first tool that we'll look at, or the first indicator, if you like, on my chart are the channel, this red and the green line. Now, the horizontal part of the red and the green line is simply highlighting major pivots. So if you look at this high point, the pivot level, and for me, a major pivot is a high bar or a low bar with a minimum of 10 bars on either side. Have rules to the way you trade, guys. Have rules. If you don't have rules, you'll find it very difficult to apply consistent technical analysis. I have a book that I'll be sending out to you guys at the end of the webinar. If you haven't got it already, please email me, zaheer@zaheeranwari.com. This ebook will explain to you how you should be doing technical analysis from a long-term trading perspective. It'll give you clear rules. It'll remove subjectivity. And these rules are proven. A lot of the rules come from the logic before the internet, when old school traders used to draw charts by hand. That's the way you want to be trading. You don't want to get caught up in this new school way of trading on the 5-minute time frame on a £1,000 broker account. It's not going to grow you an account. You've got to be more realistic. So these major pivots, now if we look to the right hand side, you'll notice that these major pivots are associated to those round numbers that we were talking about. So the high, the two peaks here, 1.5. Look at this peak here, 1.4. If you look at this floor, 1.2. If you look at where price was consolidating or is consolidating, 1.1. If you look at the lowest point on the chart, 0.8. So it doesn't matter. Previous to this, we were looking at the indices. Now we're looking at a currency. The logic is exactly the same. If I hid this symbol, so at the top you can see the euro dollar. If I hid this, so you wouldn't know whether it's a currency, a commodity, or a stock, or an index. If I hid that symbol, you wouldn't know what you're looking at. And so a chart is simply a chart. So the application of technical analysis has to be the same. There are certain differences to be aware of. For example, stocks, you've got volume, you've got gapping, you've got earnings season, you've got the indices. So there are certain characteristics that are unique to each market. Currencies tend to be more cyclic. They go up and they go down in the same fashion. Stocks tend to go up very slowly and then come crashing down. Commodities tend to trend for a very long period of time and then consolidate for a very long period of time. So there are unique characteristics to each market, but ultimately the way of breaking down a chart in the form of technical analysis is exactly the same. So at the euro dollar, the last time I traded the euro dollar was on this bear run here. And this is when price fell from 1.4 to 1.1. That's a 3,000 pip drop. I had 5 positions running along this trend, and by the time I exited, which was about a 9-month period, I exited with just under 16,000 pips. And this grew my account by a significant percentage. Now, going back to what I was saying with the index, after every move, the market consolidates. And that's what you see right here. Now, look at the length of consolidation. This is March 2015. The low, and you can see that since then it's gone into consolidation. We're now in December 2016. So look at the length of that consolidation. One of the key aspects to trading is understanding how to manage a portfolio. I often hear people use arguments such as, oh, I can't trade like that because that doesn't suit my personality. It's absolute nonsense. It's absolute nonsense. You cannot use that kind of mindset to come into the market and say, that doesn't suit my personality. What you want to understand is how the markets operate. And you then want to adapt yourself to the market. Regardless of what personality you have to adapt yourself to the market first. Once you've adapted yourself to the market, you can then tailor certain approaches to you. So, for example, you may be more aggressive, get in earlier into a trend that's established itself. A more conservative trader may wait a little bit longer. You may adapt. An aggressive trader may like to risk 2% per trade. A conservative trader may want to risk 1% per trade. That is how you adapt. That is how you adapt trading to the way you are as a person. But before you get to that stage, you have to understand what kind of market conditions you're in. Are you in a trending market or a consolidating market? If you're in a consolidating market, you generally want to stand aside. There are sometimes strategies that you can use to trade consolidations, but in general terms, you want to be standing aside. In a consolidating market, you have more chance of losing money. In a trending market, you have more chance of making money. This is a fact of the market. This isn't something that I'm making up. This is a fact. When you have a trend in play, you have the weight of the market in your favor. This is where the market makers are, the institutions. This is where the liquidity is. So you simply need to find an entry point and go in that direction of the trend. Whereas when you're trading consolidations, market makers generally have left at some point and they've gone somewhere else to cause trends. It could be another currency, it could be another stock. This is why you must have good software to be able to highlight these opportunities. And this is why you want to have a big, you don't want to just be looking at the euro dollar all the time. It's not going to make you money. So and the euro dollar is highlighting that. Here is the trend where we made very good profit. And here is the consolidation. Now that 16,000 pips that I mentioned, guys, during that 9-month period, it took me no more than 15 to 20 minutes of screen time in 9 months, not 15 to 20 minutes a day, 15 to 20 minutes in total in a 9-month period. It doesn't take a lot of time to make very good profit in trading. What you guys need to understand is that trading has its own set of skills. Just because you may be good at maths or good at economics, or you may be a business owner of a 7 or 8-figure company that you've started from scratch, doesn't necessarily make you a good trader. You have to understand the set of skills that makes a good trader. And remember, it's a skill. So what does that mean? It can be learned, it can be nurtured, it can be perfected. But you have to be open to the fact that you may not know what that skill is right now and that you've got to learn it. Don't think that just because you've opened a broker account, you've downloaded a bit of software, you put a bit of money into that trading account, that you suddenly are going to be a good trader. That's not how it works, guys. You got to remove the ego. You got to be humble. You got to adapt yourself to the market. You got to learn what you're doing, and then you've got to start giving it time to see that money coming in. If you give it time, and I'm not talking about 10, 20 years, I'm talking about, anywhere from 2 to 5 years. If you give this time, you'll be very handsomely rewarded. Of knowledge. Think about it as a startup. Most startups fail in the first year. Trading, effectively, if you start trading, it's a startup. So your goal really is to make it to the second year. That's your first goal, is to make it to the second year without blowing an account. If you've already blown an account, then technically you failed as a startup. Of course, the joy of trading is that you can simply put in more money. The broker is happy for you to load it up with more money. You've blown £1,000, let's put in some more. It doesn't matter. But technically, as a startup, if you've already blown an account, you failed. I started trading in 2007, and in almost 10 years of trading, guys, I've never blown a trading account. And that's not because I'm a genius or a wizard. It's simply because I approached it in the right way. I found someone to teach me. I got a good mentor. I invested good money into software, into training, and then I started leveraging the salary that I had coming in. Years to become a full-time trader. If you do it correctly, you can do that in a much quicker time. But going back to 2007, given the time and the money they had coming through, the software at the time, the support at the time, 4 years is a very good achievement. But if you do it correctly, you can do it within 2 to 3 years. Okay, so going back to what I was saying, once price has broken out of the support, look at what's happening. We're seeing weakness to the downside. Price closed below this pivot support yesterday, but that's still too early, because given the length of this consolidation, price could just bounce back up and stay within this consolidation. So I want to see a trend establish itself to the downside before I start looking to take any shorts. We do have the figure 1 here. So if you're aggressive, you'll get in above the figure 1. If you're conservative, so this goes back to what I was saying earlier, allow the trend to establish itself. What kind of trader you are, aggressive or conservative, we want to be trading trends. This is where the money is. Once this has broken, if we get an entry above the figure 1, we'll start looking to go short. Conservative traders will wait for the figure 1 to clear, wait for price to come below 1, so this becomes resistance, and then find an entry point going short, hold and compound strategically towards 0.9, 0.8. So if you like a projection, this is my projection. If this breakout doesn't hold, then price is going to reverse and it's going to stay in this consolidation. Breakout holds, which we want to see, and we want to see another leg like this trend to the downside, then we want to see price move towards 1. We want to see it clear 1 and then go towards 0.9 and then 0.8. That's a move of 2,500 pips. That last move, which was around 3,000 pips, was over a year. This move going forward could materialize over the following 6 months to a year, given the length of what's happened here. And why am I saying 0.8? That is because it's the lowest point that we can see at the moment. If I compress the chart, you can see that we've got a further low going back to around 0.5. So those are my projections. Now looking at the weekly, we're below the weekly 200, giving price a bearish bias. I have a trend filter, which really removes all of the noise, all of the random pullbacks. It just gives me periods of green, periods of red. You can see my trend filter is now red on the weekly, and on the daily time frame below the daily 200, giving price a bearish bias. Trend filter is also red. So this is really looking interesting, because on the monthly, price is below the pink line, so it has a bearish bias. Below the 200 on the weekly, below the 200 on the daily. So that's alignment, so bearish alignment across all the time frames. And I've got the red trend filter on both time frames. For now is a little bit more further weakness, and then I will look to start entering. I may be aggressive depending on how much space there is to the figure 1, or I may be conservative. I'm going to allow price to dictate that. Okay, let's have a look at some of the other currencies. The euro Canadian dollar, that's looking fairly interesting as well. Now the euro Canadian dollar is inside the pink lines, but it is moving to the downside. It's below 1.4 currently, and if you look at where the next support level is, 1.3, so we've got move of around 1,000 pips. If I'm looking to trade anything within the pink lines, based on the fact that there is space, then I would reduce my risk. So full allocation of risk is usually 2%. That is if price is trading above the pink lines or below. Inside the pink lines, if there is potential for money to be made, I would reduce my risk to 1% or 0.5%. If you look at the weekly, below the weekly, trend filter is red. Below the daily 200 trend filter, below the daily 200 trend filter is red. And if you take price from this point here, apart from this spike, you can see that price has been trending quite nicely to the downside. So if you look at it from this high point here, where it found resistance at the high of the consolidation, you can see that it's now trending nicely to the downside. And this is a good example of allowing a trend to establish itself and then finding an entry. So if it breaks below this pivot support, that will offer an entry to go short. So again, patience, allow that to work. Now, what are the projections? If you go to the monthly, projections again are simply round numbers. So 1.3. If it clears 1.3, 1.2. If I compress the chart, you can see that 1.2 is the lowest point on this chart. So the projections for this is in the direction of the trend, and that's for price to move towards 1.3, 1.2. If it clears 1.2, then of course all-time lows will be created, and we'll then like to see price move towards 1.10 and then the figure 1. So those are the projections for the coming months. Okay, let's move on to the DKK. Now, the reason why I'm looking at the DKK is because it's inversely correlated to the euro dollar. So whatever the euro dollar does, the DKK tends to do the same thing, but in the opposite direction. So if you have a look, we had a trend to the upside, and again, look at where it's trended to, round number 7. After every move, the market consolidates, and we're now expecting a breakout to the upside. If this breakout holds, then the projections are 8 and 9. And if you look at the past, we've got 2000 as the high. So long-term projection is 9. Ideally, price would look to break through this and move towards 10. I recently had a discussion with a gentleman regarding how I look for projections and how far price can move. And the tool that he uses is Fibonacci extension, which I'm sure several of you probably use for target levels. For me, I like to do as little as possible. Applying Fibonacci retracement and Fibonacci extension to my charts is just unnecessary, because it's an added step. It's something extra that I need to do with my analysis. And to be quite frank, Fibonacci extension and retracement are as relevant today as they were many years ago. I'd go as far as saying that using certain techniques like Fibonacci's, using subchart indicators like MACD, RSI stochastic, using wave counting like Elliott waves, I would say that these are outdated techniques and that they had their time, but we are now more sophisticated. We're more clued up as private traders. Instead of using Fibonacci extension, I would simply use round numbers. And if you cannot see how significant round numbers are looking at every chart, then you're really missing the point. And you are really the term I would say is that you're being attached to something. In trading, don't have attachments. If you find a better technique that is a more proven technique, move on. Don't have attachments to charts. Don't just be attached to the euro dollar because you feel comfortable with it. You only want to have an attachment for as long as that currency or that commodity or that stock is paying you. As soon as it stops paying you, drop your attachment, move on to the next instrument. This is a fact of the market. This is a fact of portfolio management. Okay. So if this breaks up to the upside, which it is likely to do, then we want to see price move towards 8, 9, and then ideally 10 being that major resistance, that psychological level. If we look at the weekly, above the weekly 200 trend filter is green, above the daily 200 trend filter is green. If we look at what it's been doing recently, look at this consolidation, guys. This is exactly what I mean by consolidation being very messy and very difficult to trade, period, to get involved in. But if you move it back to when it was in trend, nice smooth run to the upside. Where the psychology of trading comes in is allowing for these pullbacks to happen and then the next leg up. You don't want to close off your positions and panic. You want to stay mechanical. You want to have well-placed stop losses that allow for these pullbacks, and you then want to hold and allow the breakout to happen and to continue. If you're in front of your screen, you're going to panic. A trend is a function of time. If you eliminate time, you eliminate the trend. If you eliminate the trend, you eliminate profit. By having good software and having good trend filters, as long as this trend filter remained green, my positions remained open. Move, and then how do I manage this? I have trailing stop losses. So at some point when the pullback is deeper than normal, it will trigger me out. But look at how long I can potentially stay in the trend for. After every move, the market consolidates. We're now seeing price looking to push through this resistance. Once a trend establishes itself to the upside, we can start looking for long opportunities. Okay, the next currency we'll have a look at is the pound dollar. Okay, pound dollar, I was short here for good profit, and then I was short here again for good profit. What I'm now looking for is a move back to the downside, further weakness, and then I can look to start shorting again. I was short for good reason, and then during the results of the US election, price reversed and stopped me out. Where did it fail? 1.2. Where did the trend start? 1.7, round numbers. If you look at this whole bumpy period here, where is it? 1.5, half figure. Through, retest, next leg down. Classic price action movement. Look at where the bounce went to, 1.6. Look at where this broke through, 1.4, bounced back up, 1.5. These aren't random levels, guys. So when you go onto the larger time frames, price to a certain extent becomes predictable. If you're on the lower time frames, you're dealing with the unpredictability of random intraday noise. So what you're dealing with is all of this movement up and down day, and then it closes here. All of this random movement intraday closes here. All of this random movement intraday closes here. So you've got a trend happening to the upside, but because of all of that intraday noise, that is how private traders getting whacked out. So looking at the monthly chart, I want to see price break through 1.2. Now this is interesting. If I compress the chart, we can see that the low goes back to 1985, which is the figure 1. So if it clears 1.2, I would project price potentially reaching the figure 1. And I don't know. And I'm not going to say that it is going to happen. It's guaranteed to happen. All I would say is that if it breaks 1.2, then price is likely to move towards 1.1 and 1. Remember the logic. The trend is your friend. And so you want to keep on going in the direction of the trend. And the bear trend has been bearish since 2014 at 1.7. Since 2014, the trend has been bearish. So looking for long opportunities is really not what you want to be doing. Again, look at below the weekly 200. My trend filter is red. It was on this pullback that I got stopped out. And looking at the daily time frame, below the daily 200, trend filter is green. So I don't have alignment. Red on the weekly, green on the daily. And looking at this consolidation, it's very messy. So you want to be standing aside. I was short on this from 1.4. So this is Brexit. When price broke 1.4, that's when I entered short. And I held my position till this bounce. I got stopped at around here. So that was a hold of around 2,000 pips. I went through this consolidation period. Period was, it's unsurprising. The reason for that, summer months. July, August, June, July, August, these are the summer months. People are on holiday, market makers on holiday. Market consolidates. This is where you have to hold, apply patience. Look at September to the downside. But because of the US elections, the trend was short-lived. If the US elections weren't this year, then this was a very good, there would have been a very good chance that this trend would have just continued towards 1.1 and 1. But that's the nature of the beast. You hold on for as long as the price dictates. So that's my projection for the pound dollar. I would expect all the other pound currencies to do something similar. So pound Aussie, pound New Zealand dollar. I would expect them all to do very similar things, which is if the pound dollar continues to weaken, then I would expect all the other pound currencies to weaken as well. If we look at the euro pound will be the opposite to the pound dollar because the pound is the counter currency. We can see that we're above the pink lines, bullish bias. Look at where it found resistance. It's now weakened. It's finding some kind of support level, and we want to see price bounce to the upside. If it clears this high, then the figure 1 would be my projection for the euro pound. Above the weekly 200, trend filter is green. Above the daily 200, trend filter is red. Now the daily 200, we want to see act as a level of support, just like we did here. Bounce. We want to see the same thing happening here, and we want to bounce to the upside. If you're a pullback trader, bouncing off the 200 moving average is a possible entry point. So if you're aggressive, you may want to get in long at this point around here, and you may see a bounce to the upside. Conservative trader would wait for this high point to be clear. Of course, that's quite a lot of time before that happens, but that doesn't matter. This is where portfolio management comes in. While this is setting up, you could be looking at the US dollar, Turkish lira, US dollar, Swedish krona, the euro dollar, the US dollar, DKK. There's stocks that are already in play. So just looking at the euro pound and waiting for this to clear here is not necessarily a bad thing. Opportunities that are presenting itself. Let's have a quick look at the Turkish lira. Now I'm already long on the Turkish lira, and we can see why. Price is trading above the pink line, so it has a bullish bias. This consolidation, guys, round number 3. price move towards 4 and 5. Those are my projections. If it's trading above the weekly 200, trend filter is green, and trading above the daily 200, trend filter is green. Look at the move, breather, consolidation, pullback, whatever you want to call it. What we now need to see is a breakout to the upside. Look at where that pullback happened to, and this is why I'm saying tools like Fibonacci extensions are very unnecessary. It pulled back to a previous support level, previous support level. Remember, these are zonal areas, so price doesn't always come on bang perfect to the pip, but it came to this support zone. We've now had a bounce to the upside. What we want to see is price break and close above this pivot resistance, and that's when I'll start compounding and adding further positions. When that happens, it happens. I cannot dictate that. That's what down to the forces of the market, and that's price. But the likelihood of a continuation is stronger than a reversal. We're playing on probabilities. Okay, the last currency that I will look at is the US dollar, Japanese yen. And this is a good example of how currencies are cyclic. Bearish trend, bullish trend, bearish trend. We're now in a move to the upside. You can see that price is trading inside the pink lines. So if you're conservative, you may stand aside. If you're aggressive, looking at the way price is moving, it's trending, you may find an entry point but reduce your risk. Once it breaks above the high point, then we'd like to see price move towards 130, 140, 150. Those are the projections. If this fails within the pink lines, then we would like to see price reverse towards 100. If it clears 100, then this move to the downside, which is just below 80. Above the weekly 200, trend filter is green. Above the daily 200, trend filter is green. Positions running since 110. I'm now looking for compounding positions. I'm now looking to add further positions to the positions which are running since 110. So you can see good profit now. So while the euro pound sets up, positions already running on the dollar yen. Positions already running on the US dollar, Turkish lira. Euro dollar top of my list, US dollar, Swedish krona top of my list, all looking very interesting. In addition to that, just to give you guys a quick idea, my best performing instrument of this year has been NVIDIA. So a lot of you guys will be familiar with NVIDIA. They're a graphics card company. They're now branching out into artificial intelligence. I've been long on NVIDIA since $40, $100. $100 is a significant level. If it breaks, then the next projection is $150. If this bounces, then I've got my stop losses in play that are going to protect me. I've got significant profit extracted already from this stock. I'm now looking to either protect that, I'm now looking to either bank that through my stop loss, or we're looking for price to break through 100 where my positions will grow further. The trend is your friend until the bend at the end. Above the weekly 200, trend filter is green. 100, trend filter is also green. You can see here again, guys, a gap up, bit of a consolidation, and now we're seeing further highs. This is the move of yesterday, so Wednesday and Thursday. Being Friday, we may see profit taking, so price may not break through 100, but ideally we want to see this momentum continue to the upside. That is NVIDIA, which is a US stock, and one of my best performing UK stocks is a company called Boohoo EY. Above the pink lines, above 50, and this is now moving towards 140. If it clears 140, 150. If it clears 150, then 200. Okay, so it's really about having a good portfolio management. You can see above the weekly 200, trend filter is green. Above the daily 200, trend filter is also green. Okay, I'm conscious of the time. Okay, are there any questions? Doesn't seem to be any questions coming through the chat box, but I hope those projections, if you like, were of relevance to you. I'm just going to go to Google Hangout. Okay. Okay, doesn't look like there's any questions coming through. If you do want to contact me, guys, first of all, this is the ebook. I hope you guys can see it. Administrator, can you see the guide that I'm showing right here? the ebook. Okay, I'm okay. How about now? Can you see the ebook now? Okay, fantastic. Okay, so this is the ebook, guys. So if you haven't got this ebook, it's the Almost Complete Guide to Trading. It's written by Anne Chapman, an amazing lady who taught me how to trade back in 2007. And it's a groundbreaking ebook, guys. This ebook will change everything you understand about trading, the way technical analysis should be done, the way you should be approaching the market. It's a groundbreaking ebook. You're not going to find information like this anywhere on the internet. The internet is clouded with a lot of misleading and a lot of misguiding, a lot of inaccurate information. You want to cut through all of that and go straight through this ebook. It's almost like a seed that's coming through the rubble. This information that I'm sharing with you, the information that's in this ebook, is powerful information. So you have to question why it's being drowned out by day trading and scalping, and who that actually feeds. Does that feed you, or does that feed the brokers and the people that are claiming to be able to teach you ways to quick riches? You have to question everything. There is no such thing as a get rich quick scheme. What this is empowerment, but empowerment comes with knowledge and time. So start back from the beginning. Go back, take steps back, and start with the foundation that may not be there. Something as simple as the trading bias, understanding that, and then establishing the trend. The difference between the bias and the trend is significant. Important resistance, pivot points, this goes all the way through to a trading plan. And the book comes with diagrams, explanations, everything. It's a good 60 odd pages of information. So please email me on Zaheer@ZaheerAnwari.com. So it's simply my name, Zaheer@ZaheerAnwari.com. You can also contact me through various other social media sites. Now, if you want to take your training, your trading to the next stage, we offer training. Training starts at £99 for a whole month of training. It's just £99, guys. Not invest that, and you'd rather lose that in the market, then you've got to question why you're trading. £99 for a whole month of training. That's community support, breakout strategy, pullback strategy, understanding compounding, risk management, portfolio management, trading, training in foreign exchange, training in stocks, access to some of the software, weekly webinars. There's just a lot of information and time that goes into this for £99. If you're in the UK or the EU, that's including VAT. So please contact me regarding the ebook and the training. If you want to contact me on Facebook, please add me. Just search for my name. I've also got a Facebook page, so City Trader Lifestyle. So if you search for that, City Trader Lifestyle, you can see that I put up a lot of charts and information. I'm on LinkedIn, so please search for me on LinkedIn. I'm also on Instagram, fx.mentor if you're on Instagram. And finally, please follow me on Medium. I'm not sure if you guys are aware of Medium, but Medium is owned by Twitter, and it's a blog site. And I with different currencies and stocks, etc. So again, just search for my name and please follow me. Lots of blogs. You can comment, question, everything that needs to be done. Okay, so once again, regarding the ebook and the training, please email me on Zaheer@ZaheerAnwari.com. Okay, that's me for today. Wishing you all a lovely end to the week and a wonderful weekend. I look forward to hearing from you guys. Thank you, administrator, and all the best for the rest of the year. And I'm not sure if this is the last webinar I do this year, but if I don't speak to you or hear from you, wishing you all the best towards the end of the year, and a wonderful Christmas and a happy new year. Take care, guys. Bye-bye.